Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is a special edition where our focus is on the quarterly earnings of LTIMindtree. That's reported a 17% year-on-year rise in the net profits at 1168 odd crore rupees for the third quarter. And also the company's revenues have increased 4.6% to over 9,016 odd crore rupees in the corresponding period of the period under review. But what we've seen is that the LTIMindtree shares have actually reacted very sharply after the earnings were reported last evening, and they've fallen about 11-12%, the most since March 2020 in reaction to the quarterly earnings. To understand the impact of the kind of earnings impact that we have seen on the markets and the outlook going forward, I'm now joined by the top management of the company. Sudhir Chaturvedi now joins in. He's the president of LTIMindtree. Very good morning to you, sir. Good to have you with Business Today Televisions. Well, the numbers on some of accounts have actually come in below street estimates, at least when we talk about the revenues and the margins. What do you think are the key reasons? Is it just the seasonality factor, higher furloughs that were already expected by the street even before the earnings had come out? Or is there something even more that's being seen as a more pain point by the investors at large?
Thank you, Sakshi. Thank you for your time this morning. Always a pleasure to speak to BTTV. I think what we saw this quarter was, as we came into the quarter, we expected a certain level of furloughs in the usual verticals, which tend to be banking, insurance, and high tech.
Yeah.
But as we went into the quarter, we saw that the furloughs were wider. They were across verticals. In fact, verticals like energy, which is oil and gas, which typically are seeing sort of record profits and growth, also announced furloughs in this quarter. So we saw them that they were wider and deeper. The other aspect that we saw was that the discretionary spend and the quick cycle spend was also very muted during the quarter. So the combination of the two was the reason behind why our growth was at 4.6% on a YOY basis. But what we were really focused on this quarter was to make sure that we converted the pipeline that we had. We had a strong pipeline going into the quarter, and we saw an order intake of 1.5 billion, which shows that we're winning. In fact, our win ratio on large deals is very good, and I think that's the momentum we want to continue as we continue to have a strong deal pipeline. So the focus will be the mid to long-term growth.
Sir, help us understand what is your sense of the macro environment at large in terms of demand. Do you see any signs of demand revival anytime soon? And by when do you see your biggest markets really recover from the kind of pain points that we've been seeing for the last 3 or 4 quarters?
Yeah, so I think it's our clients are circumspect. We are seeing this in our conversations as well as conversations about budgets. Usually by this time, budgets are firmed up for the calendar year. We're seeing that clients are still firming up budgets, and even budgets that are firmed up are being released on a quarterly basis. So, therefore, some of the longer-term spending, all of the longer-term spending initiatives are cost control initiatives. So they're looking to take out significant cost in the environment. So that's a different kind of demand environment. And I think that this caution is going to continue in calendar year 24. We're still seeing, significant geopolitical uncertainty. We're still seeing interest rates remaining where they are. And we are entering an election year. This is going to be a year where we're going to see elections in all our major geographies where our clients are, the US, the UK, France, and India as well. So I think we'll see a circumspect calendar year 24. We'll start to see perhaps, some signs towards this latter half of the year in terms of if conditions start to ease and there is better certainty in the environment. But for now, we see continued caution.
Okay. On the margins front, sir, give us an outlook. The EBIT margin stood at 15.4% in the December quarter. This is slightly lower than the September quarter. So on a sequential basis, it's slipped a bit. When it comes to your overall guidance of 17 to 18%, you're saying that perhaps it may not be possible to see that even in the fourth quarter. By when do you see that happening now? And what is the band that you really expect the margins to pan out over the next 2 or 3 quarters?
Yeah, we did in our call yesterday, we talked about, the need to invest in the business for growth. As we're seeing, our pipeline continues to be strong. And we will also be participating in some of the the short cycle discretionary spend that will come available in certain regions and in certain verticals. And for that, we need to have capacity. So our utilization is at a record high. So we need to make sure that we have adequate capacity, to be able to actually leverage these short cycle opportunities. And therefore, we're going to invest in that for growth, which means that we will push our 17 to 18% margin target. That target remains. We will get to that target, but we'll push it out by a few quarters, and we will achieve the target through getting growth back in the mid to long term, as I mentioned.
But we will for sure see that band happening in FY25.
That's vision that we will get to that in FY25. I think, as I said, there's significant macro uncertainty, so we don't want to
Yeah.
make too long-term projections. But what we see is, if the things that are under our control, right? Our deal wins, what we are seeing, what we are seeing in terms of our pipeline. If we continue to convert that, and once you look at a fourth quarter good order intake, that will naturally start to show in the next financial year, and then I think that's the best way to look at it.
Okay. On order flows, you're saying that it's strong and your winning rate is very, very strong. If I understand, over the next 1.5 years odd, do you see a similar trend going forward when it comes to the pipeline?
Yeah, in fact, our current large deal pipeline is just over $4.7 billion. This is $1.1 billion above last year. So one of our merger thesis was that we will participate in more large deals, and in terms of deal sizes will increase, and we are seeing that clearly play out. The number of advised deals, deal advisors inviting us to deals has gone up very, very significantly in the last 1 year. So the focus is really on making sure that we convert as much as of this $4.7 billion TCV that we have in our pipeline, in large deals. This is not our overall pipeline. This is just the large deals pipeline.
Okay. So, looking at the uncertainty that you're cautioning everyone
And
around.
and that's going to be the key.
Okay, okay. I lost your audio in between and therefore I interrupted. I'm sorry for that. But I understand, I want to understand from you as far as your hiring plans are concerned, looking at the uncertain environment that you're cautioning us about even now that persists, how would your hiring plans really pan out going forward from here? Is there going to be any change in the hiring plans?
Yeah, I think our fresher hiring plans will continue as planned. What we're looking at is, make sure that we are in line with our demand forecast. So, we're seeing attrition is low, so therefore, we can be more just in time in terms of, hiring. But, the focus is really as growth will come back, we will see the return to hiring numbers that we planned in the past, as well as, delivering the margins that we aspire to deliver.
Okay. Tell us some more about generative AI that has now become a focus for the entire tech space. How are you looking at this space? Are your clients now demanding more orders or giving you more orders with respect to Gen AI? How would that in turn impact the employee hiring trends also going forward? Will you look at more external hiring to cater to that Gen AI demand right now? How would you really look at this entire space?
Yeah. No, I think from a Gen AI perspective, we've taken an enterprise AI approach to Gen AI. We're looking at how AI can be adopted across the board by our clients. And we've developed a very significant technology platform for it called Canvas AI. And Canvas AI is something that clients have seen, is their ability to be able to leverage this technology through Canvas AI makes it much more seamless and faster for them to do so. We've also partnered with the like Microsoft and AWS and other companies in order to, and they're seeing a lot of promise in terms of the partnership and what we bring to the table. So we currently have about 150 plus conversations, 35 plus active engagements in Gen AI. And there are three areas that we're looking at. One is productivity. The key area is productivity. We are in a world where cost control is key, and productivity, leads to lower costs. So how do we drive better productivity through Gen AI? It's been the number one ask from our clients. The second is tech modernization. We're seeing significant tech modernization in terms of engineering legacy applications or testing, et cetera. So tech modernization is a clear area. And last but not the least, especially in customer center or call center operations, things like marketing operations, things that actually drive revenue growth for some of our clients. We are seeing a huge ask for how GenAI can be used to aid agents in order to be able to handle queries better or able to, address their, improve the customer experience of their customers. So across these three parameters, productivity, the whole revenue growth as well as
Okay. All right, I would have loved to continue this conversation, but we're facing some technical glitch at this point in time. So I'd like to thank you, sir, for being with us and sharing some insights from your quarterly earnings. I wish you all the very best for the upcoming quarters as well, and hope to see you soon to really understand more about how the industry trends are shaping up and how the demand scenario is panning out. And here's hoping that the uncertain times really last for a very, very short while, and we get to see more brighter future going forward from here. Many thanks for tuning in onto this special conversation with LTIMindtree management. The earnings have come about, there's a shortfall when it comes to the expectations this time around. There could be some more pain in the coming quarter as well. And as and when things get clearer, there is going to be a recovery perhaps in the latter half of the calendar year 2024. That's what the management is penning their hopes on as well. With that, we wrap up this conversation, but do stay tuned as we will continue to get you more engaging conversations from the earnings perspective as well on Business Today Television.